It is officially over. For months, the numbers have been visible to anyone willing to look beyond headlines and price charts. Day after day, the registered silver inventory inside the COMEX vault system declined. Not suddenly, not violently, but steadily, methodically, relentlessly. This was not a surprise. This was a progression. Market participants were told repeatedly that the drainage would slow, that inventory would stabilize, that metal would appear when needed, that the system had mechanisms in place to absorb stress, that possibility no longer exists. On December 27, 2025, the official COMEX registered silver inventory report was updated. The number that appeared was not a forecast. It was not an estimate. It was not theoretical. It was documented reality. Registered silver available for immediate delivery against futures contracts fell to approximately 38 million ounces. This figure is critical because registered silver is the only category of metal that can legally satisfy delivery obligations. Eligible silver is irrelevant unless it is converted. Total vault holdings are irrelevant unless they are registered. Only registered inventory matters, and that inventory is now at a level that exposes the system. For years, the silver futures market has operated on the assumption that physical delivery would remain marginal, that most contracts would be rolled forward, that price volatility would discourage delivery requests, that industrial buyers would delay, that investors would accept cash settlement instead of metal. Those assumptions formed the foundation of the paper silver market. They are now failing. The COMEX silver market was never designed to handle mass physical delivery. It was designed to facilitate hedging, leverage, and price discovery through paper contracts. Physical delivery was meant to be the exception, not the rule. But exceptions have become routine. The registered inventory has been drained not by retail speculation, but by sustained methodical withdrawals. Each ounce removed reduced the margin for error. Each report narrowed the system's flexibility. Now, flexibility is gone. When registered inventory falls below critical thresholds, the system loses its ability to absorb shocks. At that point, delivery demand does not need to surge dramatically to cause failure. It only needs to remain consistent. And consistency is exactly what the market is now showing. There is no longer enough registered silver to provide confidence that delivery obligations can be honored under stress. Confidence is the foundation of futures markets. Once that confidence erodes, price discovery ceases to function normally. This is not about fear. This is not about sentiment. This is about mathematics. The futures market represents legal claims on metal. Those claims do not disappear because inventory is low. They remain enforceable. And this is where the imbalance becomes impossible to ignore. The market has reached a point where the paper claims vastly exceed the available physical supply designated for delivery. This gap is not abstract. It is measurable. It is documented. The belief that metal will appear when needed is not supported by evidence. If metal were available and willing to be registered, it would already be there. Instead, registered inventory continues to fall. This indicates a deeper issue. Holders of physical silver are increasingly unwilling to part with it under existing terms. Either price no longer compensates for risk, or availability itself has tightened to the point where supply cannot respond. In either case, the result is the same. The system is now operating without a safety margin. Historically, commodity exchanges rely on inventory buffers to maintain credibility. These buffers reassure participants that physical delivery is possible, even if rarely exercised. When those buffers vanish, the market must confront reality. And reality is unforgiving. The silver market is not isolated. Silver is a critical industrial metal. It is consumed, not merely stored. Every ounce delivered reduces future availability. Unlike paper contracts, physical silver does not regenerate. This means the pressure is cumulative. Each delivery cycle compounds the strain. Each reporting period removes another layer of protection. The market is now standing at the edge of a structural limit. Not a price limit, not a regulatory limit, a physical limit. Once physical limits are reached, financial instruments lose authority. Rules can be changed, contracts can be modified, settlement terms can be adjusted, but none of these actions create metal. They only redistribute loss. The current registered inventory level represents a fraction of historical norms. It represents a fraction of outstanding obligations. And it represents a warning that the system can no longer pretend that physical reality does not matter. This is not collapse yet, but it is exposure. The silver futures market has entered a phase where every delivery window becomes a test of credibility. Each contract that stands for delivery forces the exchange to confront its shrinking pool of registered metal, and the margin for error is now razor thin. What comes next does not depend on opinion. It depends on how many contracts demand delivery, and how much silver is actually available to meet those claims. That calculation has already begun. At this very moment, the imbalance within the silver futures market is no longer theoretical. It is numerical, it is contractual, and it is legally binding. Approximately 145,000 silver futures contracts are currently positioned within the active delivery window. These are not casual trades. These are not short-term momentum positions. These contracts remained open through rollover periods, survived low liquidity conditions, and persisted despite volatility designed to discourage physical claims. These contracts are locked. Each silver futures contract represents 5,000 ounces of physical silver. This is not symbolic. This is written into the contract specifications. Delivery is not optional for the exchange once a contract stands for fulfillment. When these numbers are multiplied, the result is unavoidable. 145,000 contracts multiplied by 5,000 ounces equals 725 million ounces of silver. This figure represents delivery rights. It represents legal claims. It represents obligations embedded within the futures market structure. Now compare that figure to the registered inventory. Registered silver available for immediate delivery stands at approximately 38 million ounces. The disparity is extreme. For every ounce of registered silver, there are multiple ounces of contractual claims. This is not fractional banking theory. This is not conspiracy language. This is basic contract arithmetic. The futures market relies on a critical assumption. Not all contracts will demand delivery at the same time. This assumption has held historically because most participants treated futures as financial instruments rather than claims on metal. That behavior is changing. When market participants lose confidence in future availability, delivery preference increases. When trust erodes, paper exposure becomes risk. When risk increases, physical demand rises. This shift is subtle at first, then it accelerates. The current contract positioning indicates that a significant number of holders are no longer willing to roll forward indefinitely. These positions endured price suppression attempts, liquidity vacuums, and calendar pressure. They remained open because delivery matters. The market has entered a phase where delivery intent cannot be dismissed as statistical noise. It must be treated as a real possibility with real consequences. The silver exchange is not structured to deliver hundreds of millions of ounces in a compressed time frame. The vault system is optimized for limited fulfillment, not mass conversion of paper into metal. When delivery requests exceed registered inventory, the exchange faces a limited set of options. It can attempt to source additional metal and register it. It can incentivize cash settlement. It can alter delivery rules, or it can default on contractual expectations. Each option carries systemic risk. Sourcing additional metal requires willing sellers at current prices. The declining inventory suggests those sellers are scarce or unwilling. Incentivizing cash settlement undermines contract credibility. Rule changes damage trust. Default destroys the market's legitimacy. There is no painless solution. The imbalance between 725 million ounces of claims and 38 million ounces of registered supply is not merely large. It is destabilizing. It exposes the fundamental fragility of a system built on leverage rather than possession. This is where the distinction between paper silver and physical silver becomes operationally significant. Paper silver can be created indefinitely. Physical silver cannot. Each ounce must be mined, refined, transported, and stored. This process cannot be accelerated on demand. Supply responds slowly, while financial demand can surge instantly. The futures market compresses time. Physical reality does not. The registered inventory reflects not only availability, but willingness. Metal holders must actively choose to make silver available for delivery. The continued decline suggests they are choosing not to. This behavior is rational. Silver is consumed industrially. Once delivered, it often disappears into manufacturing supply chains. It does not return to vaults. This makes silver structurally different from purely monetary metals. As industrial demand increases and above-ground stockpiles shrink, each ounce becomes more valuable as a strategic asset rather than a tradable commodity. This dynamic tightens supply even further. The futures market, however, does not account for this behavior. It assumes liquidity. It assumes turnover. It assumes that inventory is elastic. It is not. The current delivery window represents a stress test, not a hypothetical one. A live test with real contracts and real consequences. If only a small percentage of the 725 million ounces of claims stand for delivery, the registered inventory will be exhausted. At that point, the exchange must intervene. Intervention changes markets permanently. Once participants realize that delivery is constrained, contract pricing no longer reflects supply and demand. It reflects confidence and risk premiums. Volatility increases, spreads widen. Hedging efficiency collapses. This is how futures markets lose relevance. The silver market has reached a juncture where physical constraints are asserting dominance over financial abstraction. This transition is rare, but not unprecedented. Historically, commodity markets fail, not because prices rise, but because delivery cannot be honored under stress. The warning signs are clear. Low registered inventory, high open interest, persistent delivery positioning, declining willingness to supply metal. These indicators converge toward a single conclusion. The system is approaching its operational limits. This does not require universal delivery demand. It requires only enough participants to test the system simultaneously. Once tested, confidence either holds or breaks, and confidence, once broken, does not return quickly. The exchange may attempt to manage perception. It may emphasize eligible inventory. It may highlight historical delivery ratios. It may point to cash settlement mechanisms. But perception does not move metal. Only registered ounces matter. The current numbers indicate that registered supply is no longer sufficient to guarantee smooth settlement under stress. This reality changes participant behavior. It incentivizes early action. It discourages delay. The delivery window becomes a focal point rather than a formality. This is why the current situation is different from past inventory declines. It is not just low inventory. It is low inventory combined with high delivery exposure. This combination is dangerous. It transforms a pricing mechanism into a liability structure. The futures market is now carrying obligations that exceed its physical backing by an order of magnitude. This imbalance can persist only as long as delivery demand remains suppressed. That suppression depends on trust, and trust is eroding. Once enough participants decide that paper claims are inferior to physical possession, the system accelerates toward resolution. That resolution is rarely orderly. Markets prefer equilibrium. Physical constraints enforce it. The silver market is being forced toward equilibrium, not by price signals, but by inventory depletion. This is the most disruptive path. There's no smooth adjustment when physical supply becomes the limiting factor. Only repricing or restructuring. The delivery obligations embedded within the current contracts cannot be ignored. They represent enforceable rights. When those rights exceed physical capacity, the system must choose who absorbs the loss. History shows that it is never the exchange. It is the participants. The next phase will reveal how the system responds under pressure, whether it prioritizes continuity or credibility, whether it preserves structure or enforces contracts. Those decisions will define the future of the silver market. The numbers have already spoken. What remains is execution. As delivery pressure builds, the structural weaknesses of the silver futures market become increasingly visible. This is not a sudden failure. It is a slow exposure of assumptions that no longer hold under current conditions. The COMEX system functions on confidence. Confidence that contracts can be honored. Confidence that inventory is sufficient. Confidence that participants will behave as they have in the past. Once any of these pillars weaken, the system must compensate elsewhere. At present, all three are under strain. The most critical misconception surrounding the silver market is the belief that inventory figures represent abundance. In reality, they represent availability under specific terms. Registered inventory is not a warehouse surplus. It is metal that has been explicitly committed to delivery under exchange rules. When registered inventory declines, it signals not merely consumption, but refusal. It indicates that holders of physical silver are choosing not to make metal available at prevailing conditions. This choice has consequences. The exchange cannot compel registration. It cannot force metal into the delivery category. It can only incentivize through price, policy, or pressure. The continued decline suggests these incentives are failing. This introduces a critical asymmetry. Paper silver contracts can be created without limit. Physical silver cannot. Each new contract adds a claim. Each ounce removed reduces capacity. This divergence accumulates silently until it becomes impossible to ignore. The current environment reflects that accumulation. Open interest remains elevated. Delivery positioning remains persistent. Inventory remains constrained. These conditions cannot coexist indefinitely. Eventually, the system must reconcile claims with reality. The traditional response is price adjustment. Higher prices attract supply. Higher prices discourage demand. In theory, equilibrium is restored. In practice, this mechanism is failing. Despite rising stress indicators, silver prices have not reflected scarcity. This disconnect undermines confidence further. When price does not signal shortage, participants question the integrity of price discovery. This skepticism alters behavior. Producers hesitate to sell forward. Industrial consumers secure supply earlier. Investors demand physical possession rather than exposure. Each of these actions tightens supply further. The feedback loop accelerates. The futures market, designed to distribute risk, begins to concentrate it. Instead of absorbing volatility, it amplifies it. Each delivery window becomes a referendum on credibility. The exchange may rely on historical precedent, pointing out that only a small percentage of contracts ever result in delivery. This statistic is accurate but misleading. It assumes conditions remain static. They are not. Historical delivery ratios are irrelevant when structural incentives change. When confidence erodes, behavior shifts. Delivery becomes preference rather than exception. The current positioning suggests that a non-trivial percentage of contracts may stand for delivery. Even a modest increase is sufficient to exhaust registered inventory. This is the core vulnerability. The exchange's ability to function depends not on average behavior, but on worst-case scenarios. It must be able to honor delivery even under stress. The current inventory levels suggest it cannot. This reality forces intervention. Intervention can take many forms: margin adjustments, position limits, rule reinterpretations, settlement modifications. Each intervention carries costs. Market participants understand this. They price it implicitly through behavior rather than quotes. The reluctance to register metal reflects anticipation of unfavorable outcomes. Holders prefer optionality. Once metal is registered, it becomes encumbered. It is subject to delivery at fixed terms. In an environment of uncertainty, optionality is valuable. This explains why eligible inventory does not automatically convert to registered inventory. Eligibility does not imply willingness. Willingness requires confidence. Confidence is lacking. The silver market also faces a unique challenge due to its dual role. It is both an investment asset and an industrial input. These roles compete for limited supply. Industrial demand is inelastic. Manufacturing processes require silver regardless of price fluctuations. Delayed procurement carries operational risk. As supply tightens, industrial buyers prioritize certainty over cost. This behavior removes metal from the market permanently. Investment demand, meanwhile, is reactive. It responds to instability. When markets appear fragile, investors seek tangible assets. Silver benefits from this dynamic. The convergence of these demand streams exacerbates scarcity. The futures market attempts to intermediate between these forces. It does so imperfectly. When futures prices fail to reflect physical tightness, arbitrage breaks down. The link between paper and physical markets weakens. This decoupling is dangerous. Once decoupled, futures contracts no longer provide reliable hedging. Producers and consumers seek alternatives. Liquidity migrates, volume declines. The exchange becomes less relevant. This process is gradual, then sudden. The current situation represents the gradual phase. The indicators are visible to those looking beyond price charts. Inventory reports, delivery notices, contract positioning. These data points form a coherent narrative. That narrative points toward constraint. Constraint forces choice. The exchange must decide whether to preserve continuity or enforce physical discipline. Preserving continuity often involves dilution of contractual terms. Enforcing discipline risks default. Neither outcome is benign. Market credibility is fragile. It is built over decades and lost quickly. Once participants doubt settlement integrity, participation declines. This is why inventory levels matter beyond their numeric value. They are symbolic. They represent the exchange's capacity to honor its promises. At 38 million ounces, that symbolism is weak. The delivery obligations embedded within outstanding contracts represent a stress load far exceeding physical backing. This load is manageable only if delivery demand remains suppressed. Suppression relies on belief. Belief is fading. The exchange may attempt to manage expectations. It may emphasize that contracts are financial instruments. It may highlight cash settlement options. It may stress flexibility. But contracts are legal documents. They confer rights. Those rights include delivery. When rights cannot be honored without intervention, trust erodes. This erosion does not require a single catastrophic event. It occurs incrementally. Each intervention reinforces skepticism. Each rule change confirms fragility. Participants adapt accordingly. They reduce exposure. They demand higher premiums. They exit. Liquidity dries up. The silver market is approaching this inflection point. The current delivery window will not resolve the imbalance. It will merely reveal the extent of it. Each subsequent window compounds the issue unless supply increases materially. Supply increases require incentives. Incentives require price. Price requires honest discovery. The system is struggling to provide it. Physical scarcity cannot be negotiated. It asserts itself regardless of policy. When it does, financial structures must yield. The silver market is confronting this reality. The numbers are not alarming because they are low. They are alarming because they expose incompatibility between claims and capacity. This incompatibility cannot persist indefinitely. Resolution will come through repricing, restructuring, or rupture. Which path is chosen depends on decisions made under pressure. Pressure is building. The current environment is not a crisis yet. It is a precondition, a warning phase, a narrowing corridor of options. Those who understand this do not need headlines. They read the inventory reports. They understand that once registered supply approaches zero, the system's options vanish. At that point, outcomes are imposed rather than chosen. The silver market is closer to that point than at any time in recent history. The process is underway. The final stage of any structurally constrained market is not defined by collapse, but by choice. Once physical limitations assert themselves, the system must decide how those limitations are distributed. This decision is rarely neutral. The silver futures market now faces this decision. The imbalance between registered inventory and outstanding delivery claims has removed ambiguity. The market can no longer rely on probability alone. It must confront capacity. Capacity is finite. When capacity is exceeded, resolution occurs through one of three mechanisms: repricing, restructuring, or displacement of obligation. Each mechanism preserves some participants at the expense of others. Repricing is the least disruptive in theory. Higher prices attract supply and ration demand. However, repricing requires that price discovery remain functional. In a system where price has been suppressed, managed, or disconnected from physical availability, repricing arrives late and violently. Late repricing does not restore balance smoothly. It overshoots. The silver market is vulnerable to this outcome. Once confidence breaks, price becomes reactive rather than informative. Volatility replaces signaling. Hedging becomes ineffective. Restructuring is the second mechanism. This involves altering contract terms, settlement procedures, or delivery requirements. While often framed as technical adjustments, restructuring redistributes risk. Those holding paper claims absorb dilution. Those holding physical metal gain leverage. Restructuring preserves the exchange at the cost of credibility. Participants learn that contractual rights are conditional. Participation declines. Liquidity thins. The third mechanism is displacement of obligation. This occurs when delivery expectations are replaced with alternative settlement, often involuntarily. Cash settlement is the most common form. Cash settlement resolves immediate shortages, but permanently damages trust. It confirms that physical backing was insufficient. Once confirmed, this knowledge cannot be undone. Markets, remember. The silver futures market has historically avoided this outcome by maintaining enough inventory to discourage delivery. That deterrent is weakening. The current registered inventory is insufficient to provide assurance. The market is operating on residual trust rather than structural support. Residual trust is fragile. As the delivery window progresses, each notice becomes informational. It signals participant intent. A rise in delivery notices will force the exchange to respond. Response speed matters. Delayed response amplifies instability. Preemptive response signals weakness. The exchange must balance transparency with control. This balance is increasingly difficult. Industrial participants observe these developments closely. Their exposure is not speculative. They require metal to operate. Disruptions propagate beyond financial markets into supply chains. When industrial users lose confidence in futures delivery, they bypass exchanges. They secure metal directly. This removes supply from visible markets. The result is apparent abundance masking real scarcity. This divergence distorts price further. Investors, meanwhile, respond asymmetrically. Those focused on price may remain complacent. Those focused on availability act early. Early action reduces supply for late movers. This asymmetry accelerates resolution. The futures market's role as intermediary weakens. Direct physical transactions increase, premiums rise, spreads widen. At this stage, the exchange's influence diminishes. The silver market is not isolated from broader financial conditions. Monetary policy, inflation expectations, and geopolitical risk all intersect here. Physical metals serve as risk hedges when confidence in financial instruments wanes. Silver's dual identity amplifies this effect. As a monetary hedge, it attracts capital during instability. As an industrial input, it experiences non-discretionary demand. This combination intensifies stress when supply tightens. The futures market must absorb this stress or fail to intermediate it. Failure does not require closure. It requires irrelevance. An exchange that cannot reliably deliver loses its function. Participants migrate. Alternatives emerge. Volume declines. This process is gradual, then sudden. The current environment suggests the market is approaching the transition point. Registered inventory levels are not merely low, they are low relative to obligations. This ratio is the true measure of system health. Historically, when this ratio deteriorates, markets intervene. Intervention delays resolution, but increases eventual cost. The silver market is constrained by time. Each delivery cycle reduces inventory or increases intervention. Neither outcome restores equilibrium. Equilibrium requires physical supply expansion or demand contraction. Supply expansion is slow. Mining timelines span years. Recycling responds to price, but with delay. Above-ground stockpiles are finite. Demand contraction requires economic slowdown or substitution. Neither is immediate. Therefore, adjustment pressure concentrates on price and structure. The longer adjustment is delayed, the sharper it becomes. The exchange's credibility hinges on managing this transition. Transparency risks panic. Opacity risks mistrust. Both outcomes reduce participation. The path forward is narrow. Market participants must reassess assumptions. The assumption that paper claims are equivalent to physical possession is increasingly untenable. The assumption that delivery is unlikely is being tested. When assumptions fail, strategies change. Risk models that ignored physical constraints become obsolete. Portfolio allocations shift. Hedging strategies adapt. This adaptation reduces paper liquidity. Reduced liquidity increases volatility. Volatility discourages participation. The feedback loop tightens. The silver futures market is entering a phase where stability depends on external confidence rather than internal capacity. This dependency is unstable. External confidence is influenced by perception. Perception is shaped by events. A single failed delivery, forced settlement, or rule change could reprice risk across the market. Participants understand this. They adjust preemptively. The resulting behavior accelerates the very outcome it seeks to avoid. This is not panic. It is rational response to constraint. The silver market's future will be defined by how it reconciles physical reality with financial abstraction. This reconciliation cannot be avoided. It can only be delayed. Delay increases cost. The registered inventory level is a warning, not a verdict. It signals that the margin for error is gone. The system must operate perfectly to avoid disruption. Perfect operation is unrealistic. Markets are human systems. Errors occur. Stress reveals them. The current configuration offers no buffer. This is why attention has shifted from price to inventory. Inventory cannot be negotiated. It is objective. The silver market has reached a stage where inventory data carries more information than price action. Those who understand this adjust accordingly. The outcome will not be uniform. Some participants will exit early. Others will be forced out later. The distribution of loss will reflect positioning. Physical holders are insulated. Paper holders are exposed. This asymmetry is fundamental. The futures market cannot eliminate it. It can only mask it temporarily. As the mask thins, reality emerges. The resolution may not resemble historical crises. It may be administrative rather than explosive. But its impact will be lasting. Once trust is altered, markets do not revert easily. The silver market's evolution will influence broader commodity markets. Precedent matters. If delivery constraints are normalized, other markets follow. This raises systemic implications. Commodity futures rely on belief in deliverability. If that belief weakens, financialization retreats. This retreat reshapes markets. The silver market is at the forefront of this shift. The numbers have outlined the problem. The structure has defined the limits. The behavior of participants will determine the timing. What is certain is that the system cannot continue indefinitely under current conditions. Adjustment is inevitable. The only unknown is form.